Hey guys, John Henry here, Slingshot Futures Trading Group. Welcome back. In this video, we're going to be going over another user-submitted comment. Thanks again to Alex. I'll put that right here somewhere. Thanks for the user-submitted comment there. That is a great question. What do we do with gaps? Gaps can be extremely confusing. They can be really difficult, and they can just kind of make you not sure what you want to do. You know, how do you deal with some of these gaps lately are monstrous. They're huge. So what do we do when there's a gap that's like a bajillion ticks wide? Are we supposed to wait? Do we just jump in? Do we get aggressive with the rest of the market? What's the approach? And that a lot of it comes down to the market context. So in this video, we're going to be going over a couple different examples that have different types of context and different things that kind of make them a little bit interesting, and how they will sort of show you whether or not you should wait or maybe you should get in a little bit more aggressively. All about the context. For those of you members, you hear me say that constantly. But that's going to be the video. If you have any suggestions for any other videos, feel free to drop those down in the comment section below. If you have any questions or anything that you want to send me, send those to jhb@ssftg.com. We'll get those covered for you. Otherwise, I hope you had a great trading day today. A little bit slow, a little bit grindy. Hopefully you guys like the anti-shake that I've got going on. I've got a nice little tripod set up here. A little bit of a different angle, but at least it doesn't feel like you're in an earthquake. But let's jump into it. This should be fun. Gaps are a crazy one, so it should be kind of interesting. All right, so taking a look at gaps. Gaps are, again, they're a weird beast in terms of how you want to approach them. So let's take a look at a couple different examples of gaps, and that will kind of give us an idea of the approach. So this is today's price action. We had a small gap down. And first off, so we're on the same page, because gaps can be used in a lot of different ways. I use gaps in a lot of different ways. And what I mean is the terminology and what it means. So as far as a gap, what I'm going to be talking about as far as gaps go is where a candle closes to where the next candle opens. That's going to be the gap. I'm not going to talk about the wicks or any of the other stuff in there. It's purely from close to open. Now, there are several other types of gaps that we talk about and that we use very frequently, but this specifically is the one that I'm going to be looking at. So understanding what that gap means, there are a couple different types of gaps. From yesterday's close, and if we're talking about the RTH, regular trading hours close, the RTH close is at 16:15 Eastern Time, and that is the settlement price, right? So that is settlement. Now, that settlement price, that's the closing price. That's where the gap forms. Then the next day, you have a day break, right? And then you've got the next one, which is the RTH open, which of course everybody knows is at 09:30 Eastern. And that is the open. The gap is nothing more than the difference between those two, right? Gap equals difference. So there are a couple different types of gaps. First of all, I like looking at them as in terms of the entire day. So if we take the entire day, right, if we zoom out a little bit and I look at the entire day, yesterday, the low was here, the high was here, the open was actually the low of day, so the open was right there. And then you have the close right there. Right, on that candle, that's the 4:15 close. So looking at these things, there's only one thing that we haven't talked about, that's the open. You can use the open, and we can cover that in a different video, but as far as the three major levels, I want the low, the high, and the close, and then the fourth one would be today's open, where that opens up. And the reason I like categorizing that is because I like looking at the entirety of the day and saying, okay, well, they closed here, and we opened here. That is an inside gap down. What do I mean by that? Inside of yesterday. So an inside, meaning that it opened up the next day inside of yesterday's trading range, and it gapped down, meaning that it closed here and opened here. Inside gaps, whether they're down or up, are going to have a higher probability of completing, because typically an inside gap is not going to be that far away. Now, in saying that, there are some of those days where you've got this monster ripper and then an inside gap down opens up way down here. So there are some caveats to that. But the closer the gap level is, meaning the closer the yesterday's close is to today's open, the more likely it's going to be to successfully close that gap. Basically, every gap gets closed after an infinite number or amount of time, right? There might still be some gaps open from the 80s, you know, that they'll fill eventually at some point, but we just don't know when that will be. The majority of gaps fill very quickly after they are created. The very next day is when most of the gaps fill. 60 to 70% of those gaps will fill on the very same day that they're created. Now, there are some times where it will take a little bit longer, but most gaps are filled after a week. And if they last longer than that, they become big zones of interest that we might come back to as something to kind of play around with. Now, this is one of those examples like I was talking about, right? This is the high, that's the low, there's the close, and there's the open. Technically, that's an inside gap up. But look how far away that is, right? That's miles away. So chances are it's going to be a little bit more difficult for something like that to fill, considering that it's opening up 30 points away from where it was the day before. So there is a little bit of context that comes into it, and that's where we can get into the next part. Generally, inside gaps close and outside gaps don't. Now, that said, all gaps close eventually, but outside gaps take a little bit longer to close because they're gapping away. Here we have yesterday's, high right there, and the low, and the close. We can see from this dynamic that it's a very bullish bar. It went all the way down here, all the way up here, and it closed here. That's a pretty strong bull bar. But we opened up outside gap up, meaning that, again, we gapped up, and it was outside of the previous day. So it's less likely that this is going to close the gap. And it didn't. It moved all the way back down to the previous high of day, ahead of the gap fill, started bouncing, and then reversed up until a little bit later where they finally finished the job. And that's what I mean. It takes a little bit longer for these outside gaps to get the job done if they're going to get the job done. So how do we know when to be aggressive? One of the big things that the market is hunting for when it first opens is support, resistance, something to work with. Nobody knows what's really going on right out of the gates because there's so many, there's thousands and thousands of orders that hit all at once. And there's that really, that jittery stuff where you've got to kind of wait for the market, like, okay, we'll give it a second and see what it wants to do. But a lot of that jitteriness is because it's trying to hunt out a level of support or resistance to work with out of the middle of the day. So we have an inside gap down. We know the probability is good that this gap will fill at some point today, right? The market's already bullish. So after yesterday's massive rally to the upside, we're gapping down. That adds even more context. Now it might be considered cheap. And extra caveat, we add to that it's opening smack on top of that previous support. That's a big deal, right? That little level of support, it opened on it and closed above it. It may not look like the strongest bull bar in the world, but that bull bar in this context defended the sellers. The sellers tried to take it lower and they were unable to, and the buyers closed it up. So you can kind of look at this like a breakout pullback where it tries going down, fails, goes up, and then pulls back, and that's where the candle closed. Buyers will buy the close of bar 2 very aggressively because the objective's kind of done. They're already on top of support. The context is good. There's every reason to believe that we're probably going to go up from there. Now, other situations, like this one, right? We have a massive move down. The market just got obliterated off the lows, and it inside, inside gap up, but it's miles away. So traders aren't going to take the aggressive stance here. They know that eventually it will probably fill, but this thing opened up way, way away from it. So a lot of traders are going to wait for that initial movement to see what's the game plan, right? We get that initial drive up, and sellers get bar 2. Sellers will try to sell bar 2, but notice where we're not. We're just kind of in a zone of congestion, but there's not really much in terms of support resistance here. That's a little bit higher. So it's kind of missing it. And as far as the support goes, we actually opened up on top of support. So the context is telling us that it's probably not a good idea to short this. It might be a better idea to wait, see if sellers get stuck, and then buy for a breakaway move likely to the previous high of day. The market's very bullish, and this is why we use multiple time frames. The daily chart is incredibly bullish. We were talking about how this dip in one of the morning briefs, or was it the weekend outlook? One of the videos was talking about this area as a big hot spot for buyers to be coming in on. And boy, did it rally away from it. So seeing that they opened up on top of support, it doesn't make any sense that I want to be a seller. We're not opening on resistance. The context isn't good to be a seller. And if I was a seller and I see this massive gap to the upside, I'm thinking, crap, I just gave back my entire position. I was short yesterday and now I'm negative, right? A lot of people are going to be jumping out very quickly. So you have bar 2 shorts try coming in. Bar 4 goes bull engulfing. 6 is weak bear, and that's pretty much where they knew it was kind of sealed the deal, because when 6 closed, every buyer on the planet jumped on board, and that's where the market ran away. So you can see there's a huge delay here. It's an inside gap, but context tells us that this is not a good place to look for a potential setup. So that's what I'm talking about when we're looking at the context of the situation. Typically, an inside gap will close the same day. Typically, gaps close the same day. But again, there's a lot of context. Did a gap really far away? Be empathetic. Put yourself in the shoes of the people who might have held through that, and now they're opening up and they're way negative, or they're way positive. They're like, man, I was only expecting it to go here, and now it's here. Everybody starts hitting the exits because they're taking profit or getting out of the losing position before it gets worse. So that's why gaps can be so tricky, but if you just take a couple seconds and look at the overarching context, it will give you a really good idea of what to expect for the market and how it's going to want to kind of complete the rest of the morning session. Hopefully you found that useful, interesting, entertaining. If you have any questions about it, feel free to send me an email, jhb@ssftg. Otherwise, though, hope you had a great day of trading. We'll see you all in the next one. Thanks.